Hi folks, welcome to this presentation on Treasury shares. In our question, we see that on January the 1st, X1, Winnipeg Corporation had issued 10,000 common shares at $50 a share. The fact that they're no par, by the way, just means that they let the market determine what the price is. So in that case, most shares that we issue now are no par. Okay, and it says here that the market determined those shares are worth $50 a share at the time that they were issued. Now, 4 years down the road, on January the 15th, Winnipeg decided to buy back and hold in Treasury 100 of those shares, and they bought them back from investors at $55 a share. Now, throughout X5, what we're going to see is that they reissued some of them. The first 20 of those 100 that they repurchased were resold at $62 a share. Of that same 100, an additional 10, okay, on top of the 20, okay, were reissued at $59 a share, and then the remaining 70 shares were reissued or sold for $48 on June the 1st, X5. We also give you the balance of retained earnings before any of these transactions took place in X5. And now what we need you to do is first of all make the X5 entries. Well, the first entry I did here was just the entry to record the original sale back in X1. You don't have to do that, but I decided I would put it up there. So we would have debited cash and credited common shares for $500,000 to record the original issue of those 10,000 shares at $50 a share, way back in X1. So now if we look at what's happened in X5, we bought back 100 shares, okay, and held them in Treasury. So we're going to debit our Treasury shares now, or our Treasury stock, for 100 shares based on the price that we bought them back at, which is $55 a share. So remember, we said in an earlier presentation that the Treasury shares are going to be earmarked or separated out, okay, so that we can segregate them for audit purposes, for Security Exchange Commission purposes, so we can ensure that companies aren't intentionally trying to manipulate their share price. So now, we debit the Treasury shares or Treasury stock account to show that we bought back or repurchased 100 of our original 10,000 shares. Now on March the 1st, we reissued, of those 100, we decided to reissue 20 of those shares at $62 a share. So we're going to debit our cash. So our investors gave us for 20 shares $62 each. So we're debiting cash $12.40. We're now going to credit our Treasury stock, and notice that we're issuing the Treasury shares again, not as common shares, but as Treasury shares, okay? And that's for common. So even if you want to just note that it was based on common shares, that's okay. Okay, and we're reissuing them at the same price that we bought them back at, which was $55. This would normally be an average issue price, right? The average issue price, or the average price we bought them back at. But since we've only bought back once, we're going to reissue them at that same $55 price, which is $1,100. So now what's happened? We have taken more money at $62 a share than we originally paid to buy them back at. So now we've created contributed capital of $140 from that Treasury share transaction. Okay, now what happened on the 31st of March in X5 is, again, of those 100, after we bought back or resold 20 of them, we resold another 10. But these 10 were sold at $59 a share. So we took $590 in from our investors. We reissued the shares as Treasury shares, and again, we're just earmarking them. You can say that they're related to common, because you could technically have people buying back preferred shares, but to be honest, I've never seen it, but I guess there's no reason why you couldn't. And in any case, we're going to credit our Treasury share account now for $550. Why? Because that was the price at which we initially bought the shares back at. So we issue them at the same price, okay, which is $55 a share. Now, we're creating more contributed capital, which is $40 a share. All right, why? Because we took in from our investors $59, okay, which was a higher price than what we paid to buy them back. So we don't have a gain per se. It's not a gain in the income statement because it's a share transaction, so it goes into equity as contributed capital. Okay, now on June the 1st, the balance of those 100 shares that have not yet been resold are now resold. So we have after this transaction, we have no more shares sitting in Treasury. Therefore, if we got $48 a share for the remaining 70 of those initial 100, then we're going to debit cash for $33.60, right? But notice here, what did we do? We issued them at a price that was less than what it cost us to buy them back. So most of us would think of that as a loss. But because it's not an income item, shares don't have anything to do with income, right? What we're saying is that we would now need to debit our contributed capital. For how much? Well, how much do we have? Right now at this point we have $180. That's all we can debit it by, and we need all of that and then some, right, to shore up this debit side of the entry. So the balance would go to retained earnings at $310. How do I know it's $310? Well, I know that I'm reissuing those Treasury shares at $55 a share. So now all the Treasury shares of that original 100, they've all been reissued. All of them have been reissued. So that adds up to a full 100 shares here. They have all been reissued. So I'm just highlighting that in red, that they've all been reissued. So now, if I asked you how many shares would show up in the equity section of the balance sheet and what would the dollar value of those shares be, notice that I don't have any account here for Treasury shares because they've all been reissued. Common shares, as we said before, don't change. We'll always have 10,000 shares issued, but only the outstanding ones will only be the shares that are in the hands of legitimate shareholders, not those being held by the company. But issued shares happen to be the same as outstanding here because all of the shares that we bought back and held in Treasury have now been reissued. So they are all now outstanding as well with legitimate shareholders. So now the value of that is $500,000. And again, our retained earnings, because we had to draw down on it when we reissued some of our Treasury shares here, we had to debit our retained earnings by $310 to shore up the entry. We now have retained earnings of $24,690. So this concludes our recording on Treasury shares.